Welcome, everyone. Today, we are embarking on a vital journey into the core of corporate finance, the fundamentals of cash management and transactions. Let's get started. Let's begin by defining exactly what cash management is. In corporate finance, the treasury is often called the lifeblood of the organization. Cash management is the daily process of collecting, routing, and optimizing that lifeblood. What are the basics? It is about moving money from where it is generated to where it is needed. Why is this critical? Every business faces an inherent timing gap. You often have to pay your suppliers for raw materials long before your end customers actually pay you for the finished goods. If you fail to manage this gap, even a highly profitable company can go bankrupt simply because it ran out of liquid cash to meet daily obligations. How do we prevent this? By implementing rigorous daily cash positioning and structured collection policies. When you master daily cash management, you eliminate idle balances, drastically reducing your need to borrow expensive external debt. Take a look at the flowchart on your screen. At the top, we have business operations, which inherently creates a timing gap between inflows and outflows. Cash management sits squarely in the middle to solve this. From this central node, we branch into our two primary tactics: accelerate collections to get cash in the door faster, and optimize disbursements to hold onto cash as long as strategically possible. Both of these paths converge into increased internal cash. Ultimately, by relying on our own internal funds, we reach the final goal at the bottom: reduced external borrowing. This visual proves that effective cash management directly saves the company money. Moving to slide 2, let's explore the enemy of cash management, float. What is float? It is the non-availability of funds due to systemic, transit, or procedural delays. When cash is in float, someone else in the banking system is earning interest on your money. The basics of this revolve around the order-to-cash cycle. From the moment an order is placed to the moment cash hits your bank account, there are delays: invoicing delays, mail delays, and bank clearing delays. Why must we ruthlessly reduce float? Because every dollar trapped in float is a dollar you cannot use, forcing you to draw on expensive credit lines. How do we fix it? We move away from paper checks. We implement electronic invoicing, lockbox services, and straight-through processing. A deep dive metric here is Days Sales Outstanding, or DSO. If a multinational corporation can reduce its DSO by just a few days through better float management, it instantly frees up millions of dollars in working capital without making a single additional sale. Let's walk through the sequence diagram to visualize float. On day 1, the customer initiates a payment. The money enters the mail or system phase, creating our first delay, transit float. It isn't until day 4 that the payment is physically or digitally received by the company's bank. But it's still not available. Now we enter processing float, where the bank clears the transaction. Finally, on day 6, the funds are cleared and available for the company to use. That is a 5-day total float period where your cash was completely paralyzed. Our job as treasury professionals is to compress this timeline to zero using digital tools. To manage cash, you must know how to move it. Slide 3 covers the mechanisms of money transfer. What are these? They are the electronic networks that facilitate domestic and international payments. The basics divide these into 2 buckets: high-value, urgent payments, and low-value, non-urgent payments. Why do we need different systems? Because moving money instantly is expensive. You must balance the urgency of the payment against the transaction fee. How does this work in practice? If you are purchasing a company or settling a massive FX trade, you use a real-time gross settlement system, or ARTGS, like Fedwire. It is instant and irrevocable. However, if you are paying salaries to 10,000 employees, you use the Automated Clearing House, or ACH. In our deep dive, the distinction is clear. ARTGS settles each payment individually in real time, completely eliminating settlement risk. ACH, on the other hand, groups thousands of payments together and settles them in batches, which is incredibly cheap but takes a day or 2 to clear. This decision tree shows how a treasury system routes payments. Starting at payment initiation, the system hits a decision node: urgency and value. If the payment is a multi-million-dollar vendor settlement needed today, it takes the left path through ARTGS. This results in real-time individual settlement and immediate funds availability. If it is a routine expense run, it takes the right path through the ACH network, undergoing batch processing before funds become available. Configuring your treasury system to automatically make this routing decision saves the company massive amounts in unnecessary wire fees. When operations cross borders, cash management becomes highly complex. This introduces the SWIFT network. What is SWIFT? It is a secure, standardized global messaging network. It doesn't actually move the money. It securely transmits the instructions to move the money. The basics involve standardized message types, like the MT-103 for cross-border wire transfers, or the newer ISO 20022 XML standards. Why is this vital? Because if a bank in Tokyo and a bank in New York don't speak the exact same digital language, payments fall into manual repair queues, causing massive float delays. How do modern treasuries handle this? They connect their cloud treasury systems directly to SWIFT via APIs. Let's look at the sample code on your slide. This is a simple API GET request for treasury balances. The system pings the bank, and the bank instantly returns a JSON payload showing the account, the balance of 50,000, and the currency in USD. This tiny piece of code eliminates the need for an analyst to log into a bank portal, download a statement, and type it into a spreadsheet. This architecture diagram visualizes our API and SWIFT connectivity. On the left, the Cloud TMS acts as your control tower. It sends an API payload directly into the SWIFT network. The network acts as the universal translator, routing an MT-103 instruction to a US bank and an ISO 20022 message to a European bank. Look at the arrows returning to the TMS. The banks seamlessly push JSON balance updates back to the system. This creates a real-time, closed-loop financial ecosystem where the global treasurer can see their exact liquidity position at any second of the day. If cash positioning tells you where you are today, cash flow forecasting tells you where you will be tomorrow. What is it? It is the rigorous estimation of future inflows and outflows. The basics involve two primary methods: the receipts and disbursements method for granular, short-term daily forecasting, and the adjusted net income method for long-term strategic planning. Why do we obsess over this? Because an unexpected liquidity shortfall forces the company to take out emergency, high-interest loans. Conversely, unidentified surplus cash sits idle earning zero interest. How do we build a forecast? By pulling payables and receivables data straight from the ERP and adjusting it based on historical accuracy. Our deep dive here is the shift to artificial intelligence. We are moving away from asking sales teams for manual spreadsheet estimates. Instead, we use machine learning models that analyze years of historical payment data to predict exactly when a specific client will actually pay their invoice, drastically reducing forecast variance. Let's examine how a modern forecasting engine works. At the top, raw data feeds ERP payables, ERP receivables, and historical payment behavior flow directly into the AI forecasting engine. The engine processes this massive dataset to generate a highly accurate short-term cash forecast. From here, the treasurer takes action based on the output. If a surplus is predicted, we follow the right path to optimize investments, earning yield. If a deficit is predicted, we follow the left path to secure low-cost funding days in advance, completely avoiding penalty interest rates. Now we arrive at the architectural plumbing of cash management, account structures, and cash concentration. What does this mean? It means intelligently organizing your bank accounts to pool corporate cash together. The basics rely on zero balance accounts, or ZBAs. A ZBA automatically sweeps its end-of-day balance up to a master corporate account. Why is this the holy grail of cash management? Because it eliminates the idle cash penalty. Without pooling, your Asian subsidiary might be borrowing money at 6% interest, while your European subsidiary has millions sitting in a checking account earning 0%. How do we fix it? We set up physical pooling to sweep that cash together so the company funds itself internally. For a deep dive, consider the in-house bank model. Subsidiaries stop using external banks for intercompany transactions. They hold virtual accounts with the corporate treasury. When they pay each other, no actual money moves, it's just a ledger entry in the treasury system, instantly saving the company millions in bank wire fees and bid-ask FX spreads. This sequence diagram shows the power of a zero balance account sweep in action. On the left, subsidiary A finishes the day with a $100,000 surplus. That cash is auto-swept up to the master account. On the right, subsidiary B finishes with a $40,000 deficit. The master account immediately auto-funds subsidiary B to bring its balance back to zero. Subsidiary B's deficit is cleared without ever taking out an expensive local bank loan. The master account is left with a net positive balance of $60,000, which the centralized treasury can now invest overnight to earn yield for the enterprise. Let's apply these concepts to a real-time, highly impactful use case, a global liquidity transformation. Imagine a multinational corporation that has rapidly expanded into 20 countries. The problem? They operated in a decentralized manner, resulting in over 150 local bank accounts. The CFO had zero visibility into total global cash. Subsidiaries were hoarding cash locally, just in case, while headquarters was forced to issue expensive commercial paper just to fund corporate operations. This is a massive destruction of shareholder value. How did they fix it? The Treasury team stepped in and implemented a centralized cloud TMS. They ruthlessly rationalized their banking structure, moving from 150 local banks down to 3 global partners. They deployed cross-border ZBA cash pooling and automated API data feeds. The execution was flawless. The result, by simply centralizing and sweeping their own money, the firm unlocked $50 million in trapped cash. They used this newly visible liquidity to pay down external debt, reducing their borrowing needs by 40% and cutting their overall banking fees in half. This is how Treasury becomes a strategic value creator. This visual starkly contrasts the before and after states of our use case. On the left, the before state is fragmented. 150-plus local accounts lead directly to trapped cash, which forces high external borrowing. Following the transformation arrow to the right, we enter the after state. By initiating bank rationalization, the company successfully establishes ZBA cash pools. These pools directly enable internal funding, bypassing the banks. All of these strategic actions converge on the final goal: maximized enterprise value. This proves that fixing your cash management plumbing fundamentally transforms the balance sheet. As we conclude our training, we must look to the future of cash management. What is happening right now? The industry is undergoing a massive shift from reactive, spreadsheet-driven departments into predictive, cloud-native control towers. The basics involve shedding legacy, on-premise servers, and embracing Agile Software as a Service, or SaaS, treasury platforms. Why? Because the modern treasurer requires absolute real-time data visibility to scale operations without infinitely adding headcount. How are the best teams doing this? They deploy robotic process automation to handle mundane bank reconciliations and use machine learning for payment anomaly detection to prevent fraud. Our final deep dive is the ultimate goal: shifting from hindsight to foresight. The Treasury of the future uses AI to analyze macroeconomic data and dynamically suggest exactly how much cash you should hold as a buffer today. To master these cutting-edge strategies and accelerate your finance career, I invite you to like this video, subscribe to our channel, and visit Quicktechie.com for premium certification prep. Quicktechie provides exclusive Q&A banks, full ebooks, audiobooks, full-length training, and interview guides to help you achieve Treasury leadership. Thank you for watching. Our final diagram maps your technological roadmap to the future. Starting at Legacy Treasury, the first required step is cloud migration and APIs. This foundational upgrade unlocks real-time data visibility. Only once your data is clean and visible can you step into the Decision Diamond, AI, and predictive analytics. This intelligence powers both automated reconciliation on the operational side and dynamic liquidity optimization on the strategic side. Mastering both transforms your department into the ultimate strategic control tower ready to navigate any financial environment.